The story of Solana, from peak to abyss and back. What do a Ukrainian immigrant engineer, a billionaire fraudster, and a technology that died 7 times have in common? At first glance, nothing. But this is a story where one man wanted to rewrite the rules of speed, another stole them, and the technology itself simply tried to survive. I spent several weeks gathering this story piece by piece. What I found turned out to be far more complex than just another crypto drama about greed and collapse. This is not a story of success, nor a story of failure. This is a story of survival. And survivors always bear scars. I've been investigating the cryptocurrency world for more than a year now. I've seen schemes that made my hair stand on end. I watched entire empires crumble, built on empty promises and lies. But this story, it's different. Because normally, when a project loses almost all its value, when developers flee, when exchanges delist the token, when the whole world writes its obituary, projects don't come back. They become victims of oblivion. But Solana came back. The beginning, an engineer who found a problem. In 2017, in San Diego, there worked an engineer with Ukrainian roots, Anatoly Yakovenko. He was born in Ukraine in the early 80s, and in the 90s his family emigrated to the United States, like thousands of other families seeking a better life after the Soviet Union's collapse. Yakovenko was neither a crypto enthusiast nor an idealist dreaming of a decentralized future. He was an engineer in the purest sense. After university, he founded his first startup, but the project didn't take off, the timing was wrong, investors weren't interested. This led him to Qualcomm, the giant of mobile technology in San Diego, where he worked for 13 years. At Qualcomm, Yakovenko immersed himself in the complex world of distributed systems, wireless protocols, and high-performance computing. He received 2 patents and rose to the position of senior engineer manager. But the most important thing he learned there was how to work properly with time. In mobile networks, time is everything. When your phone connects to a tower, signals must perfectly alternate at precisely defined intervals. If 2 devices try to transmit data simultaneously, chaos ensues, interference, information loss, failure. That's why the technology of multiple access with time division exists. Each device gets its own time slot, no conflict, no chaos. Yakovenko watched this system every day of his career at Qualcomm. And then he looked at cryptocurrencies. Crypto was booming. Everyone around was talking about decentralization, about the future of finance, about revolution. Vitalik Buterin had launched Ethereum and was writing philosophical treatises on smart contracts. The crypto community discussed ideals and dreams. Yakovenko, meanwhile, looked at the numbers and saw a torturously slow system. Bitcoin was processing only a handful of transactions per second. Literally. By comparison, Visa was processing tens of thousands simultaneously. Ethereum was better, but it was still the speed of a snail by the standards of a global financial system. And that's when Yakovenko asked the question that changed everything: why is blockchain so slow? Not because computers are weak. Not because the internet is sluggish. The problem was far deeper. It lay in how network nodes agreed with each other on truth. Imagine 1,000 computers scattered around the world. Each must agree on which transaction happened first, second, third, in what sequence. But each computer has its own clock, and these clocks aren't perfectly synchronized. The difference is in milliseconds. But when money is involved, milliseconds decide everything. In Bitcoin, they solved this problem through brute force. Miners spent enormous amounts of electricity to prove work. Proof of work. It was slow, expensive, inefficient, but it worked because it created a single source of truth. Ethereum later switched to proof of stake, proof of ownership, faster, more eco-friendly, but still required constant negotiations between nodes, coordinating the order. Yakovenko looked at this and saw one thing: bottlenecks. Endless negotiations. Endless waiting for consensus. Blockchain like very slow radio, where each participant must wait their turn to speak. And then, one night after 2 cups of coffee and 1 beer, the idea finally materialized. What if you didn't make nodes agree on time? What if you built time directly into the blockchain structure itself? He called it, proof of history, proof of history. Let me explain it more simply. Imagine you want to prove that something happened at a specific moment in time. Normally you need a witness, an external source, a clock, a timestamp on a document. But in a decentralized system, there's no central time source, no master clock that everyone trusts. Yakovenko proposed creating cryptographic clocks inside the blockchain itself through what's called a verifiable delay function. It sounds complex, but the idea is elegantly simple. It's a mathematical operation that can only be performed sequentially, step by step. You can't take shortcuts, can't calculate the result in advance. Each next step depends on the previous one, like a chain of dominoes falling. For the 100th domino to fall, all the previous 99 must fall first. And by which domino lies before you, you know exactly how much time has passed. Each transaction in the network gets a cryptographic timestamp, not from external clocks, but from the chain of calculations itself. Any node can instantly verify that this timestamp is real, that time has actually passed. The result? Nodes no longer need to endlessly negotiate about transaction order. The order is already built into the data. Consensus is reached many times faster. Yakovenko wrote about it, a so-called white paper, and published it in November 2017. Then he began looking for people who could help bring the idea to life. Greg Fitzgerald, his former colleague from Qualcomm, joined first. Then Stephen Ackridge, also from Qualcomm. Then Raj Gokul, who became operations director. 4 engineers with experience in distributed systems, data compression, and high-performance protocols. Exactly the kind of people needed. Initially the project was called Loom, but another blockchain project had already taken that name. The team chose a new one, Solana, named after Solana Beach in California, where Yakovenko loved to surf and think. The name stuck. Solana sounds like the name of a living being. And in some sense it was, the name of a technology that was supposed to change the rules of the game. The rise, when one person decides a project's fate. In March 2020, the Solana network went live. The first block was created on March 16. And it immediately became clear that Yakovenko wasn't joking about speed. Test results showed performance that was simply incomparable to competitors. Bitcoin was processing single digits. Ethereum, dozens. Solana was processing thousands of times more. And the cost of a single transaction was literally pennies, not tens of dollars like on congested Ethereum. The crypto community split into 2 camps. Some shouted, "Wow! Ethereum killer. This is the future," and rushed to buy tokens. Others shook their heads skeptically and said it was too good to be true. That you'd have to pay for such speed with lack of decentralization. That this wasn't a real blockchain, just a very fast database with a token on top. Looking ahead, both were right in their own way. But in 2020 and 2021, Solana was on top. The price of SOL tokens was growing exponentially. From pennies at launch to hundreds of dollars at peak in November 2021. Growth was truly fantastic. Developers poured into the ecosystem from all sides. NFT marketplaces, decentralized exchanges, games, financial protocols, all wanted to settle on Solana. This seemed logical: slow and expensive Ethereum or fast and cheap Solana. Solana became a second home for those tired of Ethereum's network congestion. It had innovation, it had speed, it had the energy of a young project. At conferences, founders were welcomed like rock stars. Magazines wrote glowing articles. Everyone was talking about how this was the next big thing in crypto. And at this very moment, at the peak of glory, at the height of hype, a man entered history who would change everything. Sam Bankman-Fried. SBF. On January 9, 2021, a tweet appeared on Twitter. Author, Sam Bankman-Fried, founder of the FTX crypto exchange. The content was provocative and simple at once. He offered to buy all Solana coins that were ready to sell, at a price below market. And added a crude invitation to all who disagreed to go elsewhere. Crude? Yes. Provocative? Absolutely. But that's how SBF spoke. He didn't play by the rules of propriety, he created his own rules. And in January 2021, those rules worked perfectly. Who was Sam Bankman-Fried at that moment? A rising star of the crypto world. A 29-year-old wonder kid from a family of Stanford professors, MIT graduate, founder of the Alameda research trading firm and the FTX exchange. A man who in just a few years had built an empire worth tens of billions of dollars. But what set him apart from other crypto moguls? His image and philosophy. He went to business meetings in wrinkled t-shirts and shorts, slept on a beanbag chair right in the office, played video games during investor calls. Yet he managed to convince serious people, funds, and major investors to pour billions into him. His philosophy was called effective altruism, the idea that you should first make as much money as possible, then spend it on saving the world. A beautiful idea on paper. Forbes and Fortune wrote glowing profiles of him. They compared him to a young Warren Buffett. But what interests us isn't his image or his philosophy. What interests us is his vision for Solana. SBF saw in Solana something others didn't, or rather, saw it before others did. He saw the perfect tool for high-frequency trading, for a man who had built his career on arbitrage and algorithmic trading. Low fees, high speed, this was gold for a trader. And he got to work. Alameda Research, SBF's trading firm, became one of the largest early investors in Solana. By various estimates, his company bought a huge amount of SOL tokens. This meant one person controlled a significant percentage of the entire coin. But SBF didn't just buy, he built. In August 2020, he launched Serum, a decentralized exchange built right on the Solana blockchain. This was an ambitious project. Fully on-chain trading. Order book right in the blockchain. Speed that no competitor on Ethereum could offer. Serum quickly became the flagship of the Solana ecosystem. Around Serum grew an entire universe of other projects and protocols. Radium, Mango markets, and other decentralized financial applications. And at the center of this universe, like a puppet master, stood Sam Bankman-Fried. FTX sponsored Solana hackathons. Invested money in startups building on its blockchain. Actively promoted Sol on its own exchange. The ecosystem's tokens even got an unofficial nickname, Sam's Coins. Because it seemed like all of Solana's success depended on one person. Do you see what was happening? One person simultaneously owned huge amounts of tokens, was building key ecosystem infrastructure, and was actively promoting the project through the world's largest crypto exchange. This wasn't just an investor. This was an architect, a puppet master of an entire economy. And the puppet danced beautifully. In 2021, the price of Sol skyrocketed. From pennies in January to hundreds of dollars in November. People who didn't sell their coins to SBF in January became millionaires. The project's capitalization reached astronomical values. Solana entered the top cryptocurrencies by size. Yakovenko and his team became industry stars. At conferences, they were welcomed like rock stars. But every fairy tale has a dark side. You see, the connection to SBF wasn't just luck or coincidence. It was dependency. Deep, fundamental dependency. Solana wasn't growing just because of innovative technology and quality code. It was growing because of money, influence, and massive hype generated by one person. And the higher it climbed, the tighter this connection became. When a journalist asked about blockchain prospects, SBF mentioned Solana. When an investor looked for an Ethereum alternative, SBF talked about Solana and backed it with investments. When a new startup chose a platform to launch on, SBF whispered about Solana and opened his wallet. This benefited everyone. Solana got new users, funding, and reputation. SBF got appreciation of his assets and control over an entire cryptocurrency ecosystem. Classic symbiosis, where both sides thrived. But in nature, there's another type of relationship. Parasitism. When one organism lives off another, getting all the benefits but giving nothing in return. And when the host dies, the parasite just looks for a new victim. In 2021, nobody thought about this. Everyone was too busy counting profits and planning for the future. Cracks in the facade. Of course, there were skeptics. People who pointed out warning signs. And the main signal was simple: the Solana network periodically crashed completely. Just stopped working. On September 14, 2021, the first serious incident occurred. The launch of a new token created such a surge of transactions that the network simply choked. Validators couldn't handle it. The entire blockchain stopped. For a whole day. Imagine, your bank closed in the middle of business hours and didn't reopen until the next morning because too many customers came to withdraw money. The crypto community reacted with bitter irony. What kind of blockchain can be turned off? Skeptics asked. Decentralization, you say? This isn't a blockchain, it's just a database that can crash anytime, mocked haters. You can restart this through Discord, right? Critics jeered. The Solana team responded professionally. Acknowledged the problem, explained technical details, promised to fix it. And indeed, they made improvements. But a residue remained. Distrust had been sown in the hearts of part of the crypto community. And then it happened again. And again. And again. May 2022, a 7-hour outage due to a powerful bot attack on the network. June, a 4-hour outage due to a bug in transaction processing. September, an 8-hour outage due to an error in the fork selection algorithm. Each time the team rushed to fix the code. Each time they explained it wouldn't happen again. Each time haters laughed in the comments. Each time the price dipped a bit, then recovered. Why did it recover? Because the hype was stronger than skepticism. Because SBF's money kept flowing into the ecosystem. Because the ecosystem kept growing and attracting new projects. Problems seemed minor against the backdrop of rapid ascent. But someone in the crypto community started asking uncomfortable questions. And these questions weren't so much about Solana, but about FTX. The collapse of an empire. On November 2, 2022, the publication CoinDesk released an article that shook the entire market. Journalists gained access to internal documents of Alameda Research, SBF's trading firm. What they saw didn't make sense. Alameda's balance consisted mostly of FTT tokens, FTX's own cryptocurrency. In other words, the company wasn't backed by real assets, money, or property. It was backed by tokens it had created itself. It was like a bank saying, "Yes, we have money. Here it is, bills we printed ourselves." The news was shocking, but the real bomb exploded a few days later. On November 6, Changpeng Zhao, head of the world's largest crypto exchange Binance, announced on Twitter that his company was going to sell all its FTT tokens. All of them, completely. This was a signal. A powerful, unambiguous signal that one of the market's main players had lost trust in FTX. Panic began. Panic was icy and swift. FTX users rushed to withdraw their funds from their accounts. In a single day, an amount was withdrawn that shocks us. The exchange tried to cope with the surge, laid out its reserves, but it wasn't enough. On November 11, FTX officially announced bankruptcy. $8 billion in customer funds disappeared. Just vanished. It would later emerge that SBF had used ordinary depositors' money to cover Alameda Research losses, for personal investments in property, for political donations. He took other people's money and spent it as he pleased. On December 12, Sam Bankman-Fried was arrested in the Bahamas. The charges were serious: fraud, money laundering, violation of campaign finance laws. Maximum sentence could be over 100 years in prison. In the end he got 25 years, but at that moment in December 2022, it seemed his life was over. And along with his empire, down into the abyss went the project everyone called Sam's coin. Solana. In a week, the price of Sol crashed by 2/3. From relatively high values to pennies. By year-end to even lower values. The drop from the all-time high was 96%. $40 billion of capitalization evaporated not in a year, not in a month. In weeks. Serum, the flagship decentralized exchange SBF had built, completely stopped. It turned out that the keys to smart contracts were controlled by FTX. When the empire collapsed, the exchange turned into lifeless ruins. Major projects began leaving. Goblins and other famous NFT collections announced moves to Ethereum and Polygon. Developers massively switched to competitors. Venture funds that had been flooding the ecosystem with money just days before turned away and began closing positions. A new meme appeared in the crypto community. Solana is a blockchain you can restart through Discord. This time the subtext was added, a blockchain that belonged to a fraudster. I remember the forums and chats of those days. Rage, despair, people who had lost all their savings, people who had believed in the technology and found themselves in the same boat as the biggest fraudster in cryptocurrency history. I put in all my savings. Now I have pennies left. I haven't slept in 3 nights. I don't know what to tell my wife and kids. I believed in the technology. I was among the first developers. Now I look like an idiot to colleagues who warned me. Solana is dead. It was always a scam. Now it's just obvious to everyone. Most agreed with the last opinion. Analysts wrote obituaries of the project. Experts in videos explained why Solana would never recover. Too strong an association with crime. Too many technical problems in the past. Too much lost trust. But someone didn't agree. Someone didn't give in to panic. Resurrection in silence. December 2022. Cryptocurrency winter in full force. The entire industry was in depression. People were closing positions, withdrawing money, losing faith. But something strange was happening in the Solana Labs office in San Francisco in the silence and darkness. Not because everyone had left, though many did, but because those who stayed simply worked. Without loud announcements, without press releases, without promises to change the world. Just people sitting at computers and writing code. Fixing bugs. Improving protocols. Anatoly Yakovenko would later tell in an interview, many people wrote off Solana. They thought it was the end, that it was just a corpse that needed to be buried. But what never changed, not one member of the core team left. Everyone stayed. Everyone continued to believe. Everyone continued building. Lily Liu, president of the Solana Foundation, would say even more harshly, many people looked at us and said we were a corpse. Roadkill at the side of the cryptocurrency world. But you know what? Dead things don't write code. And we did. Every day. What exactly did they do during those dark months? First, they fixed what was broken. Constant network outages, the main headache of Solana, required not just fixes but systemic solutions. The team reworked spam protection mechanisms. Implemented priority fees, which allowed users to pay a bit more to have their transactions processed faster during congestion. Improved data transmission protocols between nodes. Optimized consensus algorithms. In February 2023, there was another outage. Almost a full day of downtime. Haters gloated in the comments, but this was the last major incident. After it, the network operated without serious problems for over a year. No stops, no panicked shutdowns. Just stable operation. Second, the team began work on Firedancer, a completely independent client for validators. This was long-term strategy. Before, all Solana nodes ran on one piece of software. One bug in the code could bring down the entire network. Firedancer, developed by Jump Crypto, was supposed to fix this. 2 different clients, 2 different codebases, 2 different development teams. If one fails, the other keeps working. This wasn't a quick fix. Firedancer was developed for over 2 years. But the simple fact that they worked on it during the darkest period of Solana's history, when it seemed everything was lost, says a lot about the team's mentality. Third, and perhaps most surprisingly, in December 2022, right in the middle of catastrophe, a new project appeared in the Solana ecosystem. A meme token called Bonk. Dog theme, like Dogecoin and Shiba. No practical use, just a meme, just a joke. But the creators of Bonk did something very clever. They distributed tokens for free to everyone who continued using Solana. Developers, NFT artists, holders of certain collections, active community members. It was a gesture, a symbol, a message. We're still here. We're not giving up, and we're having fun anyway. Crypto winter may be cold, but we keep building. Bonk didn't save Solana from the collapse. It wasn't a miracle cure. But it did something important. It reminded people that the ecosystem was alive, that it had a community of creators and enthusiasts, that it could create something new and fun even from the ruins of the past. First signs of life. By spring 2023, the first signs of thaw began appearing. The price of Sol stabilized at a higher level. Not recovered to its peak, of course, but it wasn't plunging into the abyss anymore. The level began to seem relatively stable. Developers who had rushed to Ethereum and other blockchains in the panic started coming back. Some quietly and humbly, some loudly with public apologies and statements that they'd rushed to conclusions. I was wrong when I thought Solana was dead. The technology is still better, and I'm coming back, some wrote. But real change in perception happened in September 2023. On September 5, 2023, Visa, yes, that same Visa that processes tens of thousands of payments per second worldwide, that is the absolute leader in the payment industry, announced an expansion of its infrastructure for stablecoins. And it chose Solana as one of the key platforms for this. Not Bitcoin. Not Ethereum. Solana. Think about it for a moment. A year ago this network was called dead. It was called a fraudster's coin. Prophecies were made that it would completely disappear. And now the world's largest payment system was running real transactions through it with major partners like WorldPay and other payment giants. Visa's crypto division had explained the choice simply and clearly: speed and cost. A transaction on Solana costs fractions of a cent and takes milliseconds. For corporate transfers in the billions, this was perfect. For scaling the payment system, it was revolutionary. The news spread across the crypto world instantly. And though it was just a pilot project, the symbolic value was hard to overestimate. If Visa, the company that literally defines the future of payments, trusts Solana, maybe it really isn't dead. Maybe the technology really works. The market reacted positively. The price of Sol began growing more confidently. Investors returned. Venture funds started looking at Solana as an interesting option again. And then October happened. Rebirth. In mid-October 2023, Bloomberg published an article about the possible imminent approval of a Bitcoin ETF, an exchange-traded fund that would let institutional investors legally invest in cryptocurrency without needing to open specialized accounts. The news proved premature, but the market was already on fire. Bitcoin soared upward. Altcoins followed. Solana was among the growth leaders. Investor appetite returned. FOMO, fear of missing out, came back with double force. By late November, SOL was trading significantly higher. Growth since the start of the year was impressive. People who bought at the bottom for pennies increased their investments 10 to 12 times. Not 40 times like would happen later, but pretty good already. One trader wrote on a forum, "I bought SOL in January for $9 when everyone told me I was a complete idiot. That it's a dead project, that I'd lose everything. I kept holding, ignoring everyone. Now it's November, and I still haven't sold. Guess who's laughing last? The idiot, that's me, and I'm laughing." Another trader was more reserved, "Yes, the price went up, that's a fact. But I remember people who bought at peak in 2021. They're still in the red. Too early to celebrate, it's still far from recovery." And he was right. Despite impressive growth over a few months, SOL was still trading at half its all-time high. Those who entered at the peaks of hype in 2021 were still at a loss. Their portfolios were worth half what they were at the peak. But the trend was obvious and undeniable. Solana was coming back. Continued recovery. 2024 continued the story of Solana's rebirth and recovery. In January, the price broke through levels that had seemed impossible just half a year earlier. In March it rose higher. By November, even higher. Growth was steady, though with corrections. What changed over the year to keep the price rising? First, the network genuinely became more stable. Throughout 2024, there was only one serious incident, and even that lasted less than 5 hours. Compare that with 5 or 6 incidents per year during the peak problems in 2021 to 2022. The progress was obvious and measurable. Second, the ecosystem grew organically. The total value of assets locked in various Solana protocols, the so-called TVL, grew from relatively modest levels at the start of the year to more impressive figures by fall. Fourfold growth in 10 months. This meant people were putting real money into real applications. Third, new activity drivers appeared. Meme coins. Yes, oddly enough, speculative tokens with dog themes became one of the main drivers of activity on the network. Pump.fun, a platform for creating meme coins, was processing millions of transactions daily. Not the most serious or noble use of blockchain, certainly. But the money was very real. Fees flowed into the network, validators got paid, the ecosystem was getting fuel. Fourth, institutional players returned to the scene. Investment funds started including SOL in their portfolios again. According to specialized sources, the flow of institutional money into Solana-based products was measured in tens of millions of dollars weekly. Real money from real people. And finally, something happened with a strange flavor of irony. FTX, the company that had nearly buried Solana, now helped save it. The SOL tokens that belonged to FTX and Alameda Research and had been nearly worthless in 2022 now appreciated enough to be used to pay off creditors. The same coins SBF had bought and that had become worthless were now worth hundreds of dollars. The bankrupt FTX estate turned into a golden mine precisely because of Solana's recovery. Some called this poetic justice. Others simply luck. Either way, it was irony. Reaching the peak. In January 2025, at the very start of the year, Solana reached a new all-time high. The token price was higher than ever in history. Higher than the peak hype of 2021, higher than any other point on the chart. Those who bought at the bottom for pennies made 30 to 40 times their investment. This isn't fairy tale, this is math. People who believed and held when everyone said, "Sell, this is a dead project," now looked like geniuses. Resurrection had occurred. The technology had returned. The ecosystem had flourished. The story of complete recovery seemed complete. But the story doesn't end there. The story in all its details. Because I'm telling you this not to frighten, not to dissuade from anything, not to push toward any particular actions. I'm telling you because an honest story is a story with all the details, not just beautiful growth charts. If you think this is a happy ending, I have to disappoint you. Behind every beautiful climbing chart are questions without answers. Risks that haven't gone anywhere. Lessons many never learned. The first scar, centralization. Critics pointed this out from the beginning of the project, and their arguments haven't gone anywhere. To run a Solana validator, you need serious, expensive equipment. Not a home computer running on regular electricity. A professional server with a powerful processor, large amounts of RAM, and fast internet. This costs money. Big money. The result? The number of validators in the Solana network is measured in hundreds. In the Ethereum network, in hundreds of thousands. A difference of 3 orders of magnitude. The fewer validators, the higher the risk that a small group of players can influence or even control the network. The Solana team counters, quality is more important than quantity. Their validators are professionals with reliable equipment. The network is faster precisely because it doesn't try to please every laptop owner. Who's right? It depends on what you value more, speed or true decentralization. The second scar, reputation. The association with FTX and Sam Bankman-Fried hasn't gone anywhere and won't. Yes, time slowly heals wounds. Yes, the crypto community is known for short memory. But try explaining to someone unfamiliar with crypto what Solana is. Sooner or later the question comes up, isn't this the coin that was connected to that big fraudster? The guy who stole billions? Raj Gokul, Solana co-founder, said in an interview, FTX is far in the rearview mirror. Behind us. We're moving forward. Maybe, but the rearview mirror exists precisely to remember what's been left behind. The third scar, technical risks. The network became more stable, this is undeniable fact. But more stable doesn't mean perfect or flawless. In December 2024, Solana suffered one of the most powerful DDoS attacks in internet history. 6 terabits of data per second. One of the largest attacks ever recorded. The network held, didn't fall, kept working. Yakovenko called it a bullish signal. Sort of, if someone spends such astronomical resources on an attack, it means we're important enough to attack. An optimistic way to look at it. But you can see it differently. A network that attracts attacks of that scale needs to be ready for even bigger ones. What guarantee is there that the next attack will be just as unsuccessful? The fourth scar, dependence on speculation. Look at what drives the Solana ecosystem today. Meme coins. Speculative tokens. Platforms for creating such tokens. This brings transactions, fees, activity to the network. Real money. But this isn't fundamental value. This is a casino run by blockchain. Real DeFi protocols exist. NFT marketplaces operate. But is that enough to sustain the ecosystem when interest in speculative tokens fades? When people lose interest, as they inevitably will? I don't know. And nobody knows. The fifth scar, war with government. In June 2023, the SEC filed a lawsuit against Solana. Technically it was called fighting unregistered securities. Effectively it was an attempt to stop the project, cut off oxygen, block the ability to trade. The market, as always, gave in to panic. Analysts predicted delistings from major exchanges. Funds wrote off assets as losses. It seemed there was no chance against the government machine. But reality turned out more mundane. In February 2025, the SEC simply withdrew the lawsuit. Quietly, matter-of-factly, without loud announcements or explanations. The case was closed. And that's the whole point. While lawyers argued in offices, while investors drank valerian, the network kept generating blocks. The code doesn't care what the SEC or any other organization thinks about it. It doesn't know fear. It just works. Lessons for the future. Over weeks of work on this story, I read hundreds of accounts from people on forums, social media, in chats, stories of people who lived through all of this with Solana. First lesson: connections decide everything, until they become a curse. Sam Bankman-Fried raised Solana to the peak. He almost buried it in the ruins. When your main ally, main financier, main promoter turns out to be a criminal and fraudster, you pay for his sins even if you're innocent. Second lesson: technology is not a guarantee. Solana truly is fast. Truly cheap. Truly innovative. But it didn't protect it from a 96% drop. Good technology can lose to bad PR. Great engineering can be drowned by crime. Third lesson: the dead sometimes return, but not all. Solana came back. But hundreds of other projects that were buried in 2022 remained in the grave. Why did Solana survive and others not? A strong technical team. A devoted community of developers. Luck. Probably all together. But you can't repeat this path by instruction. Fourth lesson: nobody knows the future. Experts who buried Solana in 2022 were wrong. But experts who predicted endless growth in 2021 were also wrong. Anyone who tells you they know for sure where the price will go is either lying or deluded. Fifth lesson, and perhaps the main one: those who survive are ready for the worst. In cryptocurrencies, it's not the smartest or the luckiest who survive. Those survive who are ready for the worst, who don't invest more than they can lose, who understand that tomorrow everything could go to zero and accept that risk consciously. Epilogue. What do a Ukrainian immigrant engineer, a billionaire fraudster, and a technology that died 7 times have in common? They're all part of the same game. A game where geniuses and fraudsters are sometimes indistinguishable. Where technologies rise and fall by laws that have nothing to do with their actual value. Where you can become a millionaire in a year and a pauper in a week. Solana is a mirror. In it is reflected everything that exists in the world of cryptocurrency. Innovation and hype. Genius and fraud. Hope and greed. Triumph and catastrophe. This was the story of Solana, a technology that made a deal with the devil, survived its own death, and came back. A story that isn't finished yet, because the cryptocurrency saga never ends. It just waits for the next chapter.